Good evening, everyone. It is March 20th, Sunday, and 6:30 p.m. We're going to get started here. I'm going to cover the S&P 500 and see what's doing. Right now, the futures ticking down roughly two handles, nothing significant. I think that if we are going to retrace a little bit tonight, the 2030 level should hold, and then perhaps, get a bounce, and then, the retracement to the downside, 2020 is the big level, and that level needs to hold. So 2020 on the ES needs to hold for the bullish bias. But I welcome the retracement. I want the market to retrace so I can reposition on the long side, and hopefully we can actually grab a swing and swing it up to 2100. So, there is reason to believe the bull is not finished, but there is also reason to believe that a retracement makes sense, and it does not mean that the pattern is a rising wedge on the weekly. Um, we can just look at it here. We do have this wedge here that is rising off this double bottom that occurred on above average volume. This reversal on above average volume had 5 weeks of follow through. So the follow through took place on average volume, nothing too above average to make it like significant volume push. And so the next week and I'll say the next 2 weeks are going to be significant in terms of direction of this market, because we do have clearly on the primary, looking at the weekly chart, we still do have this descending trend line. It's a trend line resistance. So, the price would meet that resistance at around 207 or 207.50. I did note in the chat this weekend that there was some heavy activity in the March 31st 207 call strike in the SPY, the most option activity in that contract. So that is interesting. Um, so yeah, we clearly have a trend. I mean, on the weekly, we have an ADX at 29. That's indicative of a trend. Anything above 25, stochastic is overbought, but it gets overbought on a weekly frame doesn't mean that it just shoots right down and we're going to have a major reversal. I am anticipating maybe a little bit of pop and then a drop for retracement, but I don't think the retracement is going to be anything severe. The 202 handle on the SPY, and of course the major axis at 200 would be the line in the sand if we're going to trade lower. But I still am in the mindset of the buy the dip tactic. And I think that, well, going forward, until there's reason to believe otherwise, the trend is intact and the trend is your friend until it's the end of the trend. So we kind of welcome some downside pressure. Perhaps we'll trade it, but until we see a volume confirmation on, on the price action confirming reversal, I'm going to trade small. I'll trade a little bit bigger once we have a real shift in trend and sentiment, and we could take it down, because if the market falls, and it really falls, I'm not talking about a retracement. If it really falls, we could see the type of retracement down to 190 or something. You could get 100, 120, 150 points on the ES to the downside, and it could happen fairly quickly because it usually does. But until we see real selling pressure, the odds do favor the upside. I did just make a note on this weekly stochastic being embedded overbought. It does not mean that it's bearish because it's overbought. I mean, when I'm starting to draw the well, not starting, but recognizing the parallel between the October rally and how we had 1, 2, 3, 4, 5 weeks of reversal, just like here. So if history repeats itself, on the 6th week in October, we got a nice retracement that was bought right back up. But if that historical candlestick plays out, you could assume 202 to 200 is a reasonable downside effect that would reset the technicals on the short-term frames. So, that's that. Um, Back here in October, look how long October through into November is where the stochastic got overbought. So we had all those weeks of rallying, and then look what happened. We had this sideways range, a fast drop followed by a fast pop. I believe this was the Fed in here that had some influence there. Um, so so that led to sideways activity before the next drop. So I guess what I'm inferring here is that if we are going to see, um, you know, uh, some downward pressure, which could turn into just sideways chop and essentially flag out, um, making what could be a bull flag, or it could be an actual conclusion of this right shoulder, which seems to have been negated since we exceeded the peak of the left shoulder. But it is a head and shoulders variation. It isn't the most symmetrical and perfectly shaped, and the pattern could very well still be valid, and this descending trend line resistance could hold. We don't know, so we'll see how it plays out in the future. But I just want to add that because we are overbought does not mean that the market will just drop, and it makes sense to shift our sentiment towards a bearish leading um, bias. I don't think so. We can trade the downside. I mean, if we could get 20 to 40 points, maybe more to the downside. I mean, last last Sunday session, I made note of the inverted head and shoulders on the ES. The ES looks a little different from the SPY because it covers the after hours pricing. But let me get on the daily chart of the ES so we can see how this is potentially a inverted head and shoulders. And here's a left shoulder, and here's a head, and then here would be a right shoulder, but we never got the retracement. So I was saying last week that a retracement to 1950 would make sense in terms of maintaining the bullish bias, but now I think 1950 is too low. It's too low. I mean, considering how the week reacted to the European Central Bank as well as the FOMC minutes, it was bullish, and because of that, it makes it harder to assume that the technical reset, if we're going to get it, is going to fall back down to 1950. It could, but I'd be more inclined to buy the dip if we get down to 1920 or 1920, 2020 or 2000. You know, you have this midline on the acceleration band, 1986. So and it's possible. Anything's possible. We could come right back down there. I would be probably inclined to buy it, but I'd also be inclined to trade the downside. So we could trade the reset and essentially reverse and go long if it still makes sense to do so. If the volume profile is increasing and we start to see increasing volume with a sharp pivot in selling pressure, we'll see it quickly. I mean, it could happen over the course of days. It could happen over the course of a 1 hour candle. It could happen in a 5 minute candle where we get a real signal. It all depends. So, we'll play it by ear. But, on the daily chart, we do have some divergence. You can see the MACD cross down on the ES, PX, the price action trading at the upper acceleration band. So it does imply that we are a little bit toppy. Toppiness does not mean load up on puts and start shorting the crap out of the ES. It could be worth speculation, but I'd rather time it and kind of just wait for the volume that will meet the price action and give us reason to get that short position going. So, let me flip back on the SPY. Let's get this over here. Flip back on the SPY here. Um, this is the weekly. I want to note the monthly chart on the SPY. Stochastic is still embedded oversold. I mean, March has just been a strong reversal. Well, it's a follow through. This is month one of the follow through period following a reversal on above average volume. The the February candle closed as a long-legged doji, favoring the bulls. And if you look closely, you could see the March candle closed above all moving averages. So that does favor the bulls. March is not over. It is the end of the quarter, and this week is well, no, we still have this is week four, but because March is a 31-day month and we had Monday and Tuesday of February at the start of the month. So, we have essentially 5 trading weeks. Um, we have time here. A lot can happen towards the end of the month in terms of a window dressing scenario and also a potential pivot in the market. So we have to keep our eyes peeled. The volume profile on March so far is not above average. So, we are in the follow through period on the monthly, but it's still not the most impressive volume to confirm that this upside push can continue. And when I zoom in, like I had it on the weekly, you can see that we are overbought. The daily is substantially overbought. It's been overbought essentially since February, um, middle of February. And we are trading at the upper acceleration band. We closed with a doji on Friday. Stochastic's been overbought. All the indicators are overbought. I have a 5 period RSI at 78, and I have a ADX on a daily of 17. So that is still in a trading range, but it's strengthening, and it gives reason that the upside trend is strengthening as well. So what could happen if the market does pull back? I mean, it might not. We could just flag out sideways, go sideways for a couple days and let the short-term technicals reset. When you have a MACD or a stochastic that's overbought, let's say on your 4 hour or your 1 hour, and then it comes back down, goes below the zero line and recycles around, it could very well mean that the price action is still bullish if the price does not fall. The indicators reset, but the price doesn't fall. That means there's buyers underneath. So we're going to need to watch the volume profile closely to really gauge the truth here in the market. If it is ready to turn the corner and retrace lower, the retracement, as I said, 2020 to 2000, and then if 2000 is the line in the sand, brings us right back down to 1900 or upper 1800s or potentially the 1700s. We don't know, but um, we will need to see the volume confirmed. So what is interesting is we did have above average volume on the daily on Friday. That was the quad witching expiration of the 4 securities, which is typically an above average volume day. The market closed flat, with a doji, and it's sideways holding the highs. We're like 30 days into the follow through period on the daily. You would assume that we would come back down at least, to some extent. So I have a 10 period EMA on the daily at 202. This is the red moving average has basically been the moving average that the price has been trading higher against. As soon as we broke through the 200 EMA, which is the purple line, it's just been steady coasting higher with some flagging activity. We had a 2-day flag of inside price action followed by an explosion higher. So is it possible we flag out for 2 days and this moving average just extends and we trade into the moving average before the next move up? It's possible. So I'll be watching the 202 level on the SPY. That's very key. The 200 EMA is at 230 cents. And these clusters of moving averages below will be the support if by chance this is going to be the week where the market decides to retrace. So, I'll be on the lookout for longs and shorts, but I am a little bit, you know, hesitant to go long. The market is very overbought. I still would do it. I mean, I would need a little bit of pullback to rationalize why it makes sense to go long. I mean, the indicators don't really jive with my um, going long strategy at the moment. So, I would be interested in trading some of this reset. If we could get 20 points to the downside or more, that would just be fantastic to start the week. So, let me zoom in, get on the 4 hour. I mean, everything is just overbought. We got, what is that? That looks like what could be a long-legged doji or hanging man doji. We're just clinging on to the VWAP. That's all that I see happening here. On the 2 hour chart, you could see, the moving averages. I have a lot of indicators on my chart, but it's good to use the VWAP. VWAP is by far my favorite price action moving average, but I do of course have the other moving averages on the chart. So you could see the red line is your 10 EMA on the 2 hour, and it's just kind of, you know, well, no, I'm not going to use the red EMA. I'm going to use this blue EMA. This is the line that's been respected. You can notice on the 2 hour when the derivative oscillator crossed down and the price action gapped down, but still maintained above this moving average and maintained a V-stop buy signal. That was bullish, and it just traded sideways. This was a difficult week because it was just sideways and up, but more sideways. But the anticipation over the Fed was a bullish conclusion, an outcome, and now is the next phase. Next phase this week is how exhausted can this market get? Sometimes when the price action flags out like this and presses into the moving averages, it gets a nice press and it's either going to drop or it presses and then just shoots up. So, I'll be watching on the upside. The 205 level is key, and the 207.50 level is a major resistance. When I go to the monthly, you could see the volatility bands are up essentially at the all-time high, so it doesn't really give a good indication. But 213s, guys, we are not far from the all-time highs, and it's you can't really discount the possibility that we just blow through 2100 and make new all-time highs in the market. I mean, we're not far from it. So, but again, it does make sense to have a pushback down here. So it's going to be a matter of timing it. I go onto the hourly. Look at the hourly. The hourly's oversold. This right here is a nice example of what I'm talking about when the price action presses into the moving average. It basically breached. It ended up closing above the 10 and essentially closed above all moving averages, actually. But it closed on the hourly oversold. So, pressing into the moving averages and then shooting higher through 205 will be key. It's basically taking out the highs here. That will be a necessity if the push to 207 and beyond is in the cards for this week. So, I am absolutely not shifting into a bearish sentiment just yet. Prior to the FOMC and the last week, actually no, post FOMC with the quad witching. Quad witching could go either way. I had somewhat of a bearish sentiment. I thought that we could get a harsh, volatile reaction, but we did not. And in fact, nothing happened. The SPY just kind of traded sideways, chopped around all day. But guys, on the daily, the rising wedge is, I'm going to draw on the chart. The rising wedge is apparent, and it is very similar to the wedge we saw in October. So I keep repeating myself, but if this is a repeat of history, this ended with a beautiful retracement. And on the weekly chart, you saw that that retracement got bought right back up and made a double top peak before falling again and chopping around, but then essentially led to January's fallout. So it's possible that kind of activity happens. Um, but when we have things like we have the biotechs that are oversold, they could stay oversold, or they could get a substantial rally. The LABU, we want to see it through $6.50, and above 675 looks interesting. That could probably get a push beyond um, beyond the $7 mark. So I'll be watching that. If the biotechs can rally, that's not going to be the most bearish thing for the market. Also, the USO, you can notice that it is also overbought on the daily, testing this 100 EMA and rejecting it. So, if crude oil is going to pull back and the correlation still exists with the index and oil, then it makes sense that we get the retracement. So I'm ready for it, and um, I'm glad to trade it. But I'm more excited to trade the next leg up. If this retracement is just going to be a retracement, if it happens. The next leg up is the most interesting, because think about it. If this is a trend that's building, and the trend is strong on the weekly, it's building on the daily, but it's overbought on the daily and the weekly, it would mean that we need to have a reset for the trend to maintain its posture and push up. But resetting down to a level that makes sense to load the longs for a trip higher, and the trip higher could be substantial. It might not be like this is the end all be all for the bull wave. I mean, if we reset to 2000, a trip up to 2100 is very much not out of the question. So, when I talk about the SPY and I look at the daily, this head and shoulders, left shoulder, head, let me get the drawings off the chart, left shoulder, head, and, the right shoulder is, it's the right shoulder is not really a right shoulder. It would have been if this above average volume and reversal didn't take place. Instead, we have identical price action to what happened here. This fallout looks like a Nike check. Just do it. Look at that. Boom. Same thing. So, it is possible that this head and shoulders does still exist, but again, when we do have volume at the neckline on the head and shoulders, it could assume that the pattern gets negated and absolutely rejected, and that the march higher could continue. So, we're just going to keep riding the moving averages higher until there's reason to believe the opposite behavior can occur. So anyway, I'm 23 minutes in. I'm going to cut this video. I hope everyone had an excellent weekend, and I look forward to an excellent trading week. Thank you.